All right, so we are going to um we're gonna do some practice exams here. We're gonna go through right here. Bam. Okay, so I could always edit this out. Pablo. So what is okay, so we could start, Pablo, with maybe the questions that you have. Do you have any questions for me? Anything like specific that you want to go over that that you've been studying that you're having a hard time with?
I think it's just the meaning behind the word, and that I know that
The vocabulary?
the vocabulary.
Oh, okay, okay. So for vocabulary, I'm gonna recommend you do the so again we go to the link right here. You see how well, this is California, right? So in California, I have you focus 4, 5, 1, 3, and 7. Um, but also if you scroll down a little bit, um, there's there's a vocab visual study guide that I did. I recorded this a long time ago and it's really good, bro. This is something that you should do, or if we're able to do this again, do this before you take the exam. But this is once you're scheduled, but still because it's a good refresher because a lot of these vocab words you have to understand them. So when you're taking your test, you pass it, okay? Um, but but that's all this is. These are YouTube videos. So I'm gonna click on contract law. If you click on the YouTube video, okay, that didn't work. Let me go to a different one. Is the internet down or something? There it is. See that? So contract. So you see how it has, like, for example, the MIB, and then it gives you an explanation. This is me explaining it, and also it gives you like key phrases to remember when you're taking the test, so that when you're taking the test, you remember, you're like, oh, I remember that, and then boom, you get the answer right. See that? But you have to do that, and you have to do that one. Okay, so but that's step 3. You see that this is already when you're scheduled for taking the test. All right.
Should I watch them before I take the
You
test?
could. Yeah. Yeah, in your own time when you're driving, just put it there on your cell phone and watch these videos. These are really good videos. And I think they're gonna really help you out. Okay. So since you're not let's see, this link, what I did is chapter 451. I don't have any playlist on chapter 1. So let's go through chapter 1. Okay, we're just gonna jump in on chapter 1. There's 9 questions on the test in the state of California for this one, and I'm gonna go straight to the exam. And you're putting your time, bro. You just gotta put in more time because honestly, it requires a lot of time for you to master this. But I could see that you're putting time, so that's good.
Yeah.
Okay, contract which one party undertakes to indemnify against another loss is called.
Yeah, that's where I get lost.
Zoom in. Okay. So whenever you see a contract, this is where I come in, bro. This is a value that I bring to the table, okay? And Ray too. Ray knows a lot about this too. But this is what you're gonna learn with me, okay? Key phrases. Okay. So when you see a contract, what it's talking about is a life insurance policy. Bam. Look at that. See that? Life insurance. So a contract is insurance contract. Insurance policy is the same thing as insurance contract. Does that make sense, Paulo? So just think of, is this yours, right?
No, this
So whenever you hear the word contract, just think of a life insurance contract, which is the same thing as a life insurance policy. See that? And so right here it says a contract life insurance or insurance contract, insurance. And that's why that's the answer. Indemnify. These are words you don't use every day, but you got to know what it is. Once you pass the test, you could just forget about it. You don't need to remember it, okay? Indemnify means to make whole, to take you back to how you started, right? So you see this cup right here, it's whole. But if I drop it, 1,000 feet in the air and it smashes, it's gonna break, this is gonna break, this is gonna smash, right?
Yeah.
So what does insurance do? Insurance is gonna bring it back to whole the way it was. That's called indemnity. Okay, that's called indemnity. In those videos that I told you, I explained that. See that? So what you could do is if you don't still don't understand indemnity, then you could just rewind, just tap back, right? Just like it's a YouTube video, right? So just tap back, indemnity. Okay, that's what it is. Because you are gonna have to remember these vocabulary words. Make sense?
Mhm.
Any questions on that?
Uh, Pretty clear.
Okay. So an insurance contract which one party undertakes to indemnify or make whole against a loss. So if there's a loss, it broke, then it's called insurance. See that? All right. And every time you do this, read the rationale, especially if you guys that are watching the replay on this video. It says an insurance contract is whereby one undertakes to indemnify another against a loss, damage, or liability arising from contingent or unknown events. Now check this out. Here's another great tool. You have your phone?
Yeah.
Do you have ChatGPT in it? Okay, this is a freebie for all of you guys that are watching. Okay.
Nope.
Download it. You need it. All you guys, go ahead. It's crazy how a lot of people still don't use ChatGPT. ChatGPT is it's artificial intelligence. You gotta use it. Or else somebody is gonna use it and take your job. You know what I mean? You have to use AI to your advantage. It's a little cheat code in life. It's a life cheat code. And it's crazy that I've been giving this tip for a lot of people, and a lot of people I'm very surprised honestly how many people still don't use ChatGPT.
I use it just on my computer, not really on
Oh, okay,
my
okay.
phone because
Yeah, get it on your phone. Use it everywhere on your phone, on
my
anything.
phone's like messed up. So like
Yeah.
trying to type in anything, it's just like
Oh, okay, 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 okay. Um, let's see what I could do. Let's see if ChatGPT allows me to
I mean, you can use it as a like not even logged in user.
yeah, but I'm actually paying for the service.
Oh, you're paying?
Yeah, because I'm telling you, man, I use it all the time, all the time. Okay, so watch. So I'm gonna use it as a voice mode. Okay. Let me see if I'm doing this right, okay? Because I'm gonna do it in front of you guys right now, and you guys are gonna love this, okay? So here we go. Voice mode. Allow while visiting site, allow this time, allow while visiting site. All right. Okay, so I have a question. I'm gonna read to you something and I need you to explain it in simple terms. And by the way, on your cell phone, this version is available. Tiffy works.
Sure, go ahead and read it out to me, and I'll do my best to break it down in simple
It's
terms for
talking,
you.
but I can't hear it.
I can't hear you.
So it doesn't, I guess it doesn't work when I'm doing Zoom or screen sharing. It's like a private recording.
You can also wait.
That sucks. Let's see if I stop the share. Let's see if it does it. Hold on. Hello, are you there?
Oh,
How the audio works while you're on Zoom. Okay. I'm gonna make it work right now. Give me 1 second. On sound, I'm gonna use the studio display speakers. Hello? Say something.
Hey, I can hear you. Hopefully the sound is working well on your end too. Let me know if everything's good now.
Okay, it works. Perfect. Okay, cool. So I'm gonna screen share real quick. Let me see if this works now. All right, can you hear me now?
Yes, I can still hear you loud and clear. Looks like
Perfect.
everything is
Okay, so
awesome.
I'm gonna show you. I'm gonna say something, and I want you to explain it in simple terms, okay? Because I read the sentence, and I'm like, what the heck is this, Chinese or something? But it's English. So here it is. The sentence says, "Insurance is a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or unknown event."
Sure. So that sentence just means that insurance is basically an agreement where one party promises to protect the other from any kind of loss or damage that might happen unexpectedly.
See that? Simple. Did that make sense to you?
Yeah, that made more sense.
See that? So that's another tip I have for you. It's like having me, but better, bro. Because you're taking them around everywhere you go on your cell phone or on your iPad or whatever, you know. And you basically explain to him to explain it to you, even in your like at your level, whatever. You could even like if let's say you didn't speak English, you could say in Spanish or in Chinese or Korean or whatever. It's really cool.
Exactly. It's super handy because you can basically get explanations in whatever way works best for you. It's like having a personal explainer right in your pocket, ready to help out whenever you need it.
Okay, so here's the next question. Which of the following insurance options would be considered a risk sharing arrangement? Risk sharing arrangement. A, surplus lines, B, mutual, C, reciprocal, or D, stock. It's either B or C. Haven't done this in a while, so let's see.
So in this case, the answer is actually C, reciprocal. Reciprocals are a type of insurance arrangement where the members share risks with each other, kind of like a cooperative. So that would be the risk sharing one.
See that? And then always, when you get the answer, always read the rationale. When insurance is obtained through a reciprocal insurer, the insured are sharing the risk of loss with other subscribers than reciprocal. Now, I was gonna say mutual because mutual is like a mutual agreement. You know what I mean? That one makes sense because of the vocab word, the logic of it. Pero in the test, that's not the answer, right? In the test world, the answer is reciprocal. Okay.
Yep, exactly. Sometimes the logic of the vocabulary can be a bit tricky, but it's always good to double check the rationale behind the answer. That way, it
Okay,
really
next
sticks.
one. You don't have to listen to him if you don't want to. The insurer must be able to rely on the statements in the application, and the insured must be able to rely on the insurer to pay valid claims. In the forming of an insurance contract, there it is, contract again, remember? This is referred to as, so again, anytime they say contract, they're talking about an insurance contract. This is referred to as reasonable expectations, a warranty, implied warranty, or utmost good faith. I'm going to say D, but let's see what it is.
You have to click submit.
Dang. We'll go back to that and see if we got it right. All right, let's just go to the next one. All of the following are examples of risk retention except A, deductibles, B, premiums, C, co-payments, D, self-insurance. Is that risk retention? Go ahead.
Sure. So when we talk about risk retention, it means that you're taking on some of the financial responsibility yourself. Things like deductibles, co-payments, and self-insurance are all ways of retaining risk. But premiums are actually what you paid to transfer the risk to the insurer. So that would be the exception here.
Dude, that's really good. It's well explained, bro. That's better than what I would have been able to explain it, to be honest. I just knew premiums, but I didn't know why. Well, he explained it. Premiums is because premiums the way of you says retention. Yeah, transferring your risk. Retention is a planned assumption of risk or acceptance of responsibility for the loss by an insurer through the use of deductibles, co-payments, and self-insuring. Bam. Can you explain that in simple terms?
Absolutely. Basically, risk retention just means that you're choosing to handle a part of the financial risk yourself. So when you pay a deductible or a co-payment, or if you have self-insurance, you're taking on some of that responsibility instead of passing it all on to the insurance company.
Make sense?
Yeah.
Yeah, bro, you'll pass this test if you study like this. All of the following are insurable events as defined in the insurance code, except insurable events. A, an insurer goes to the hospital for a broken arm. B, an insured is sued for libel and slander. C, an insured loses a large sum in a poker game. And D, a guest trips and breaks his leg on an insurance house. So all the following are insurable events and except. So which one is not insurable? C, because you can't insure a poker game. It's called speculative risk. Pure risk is insurable. Speculative risk is not insurable because you have a chance of winning and you have a chance of losing. And so when you're taking the test and doing that, just remember the vocab words that are not here, but but it has to do with the question. Okay. And I like to repeat it too, because that way or when you watch this replay, you remember what is pure risk. I just give you like a little seed just in case you had forgotten what is pure risk, what is speculative risk. You at least remember that because that's going to be on the test also. So any event, whether past or future, which may damnify a person having insurance interest or creating a liability against him or her, may be insured against. Speculative losses are uninsurable. There it is. So speculative losses or speculative risk is the same thing. Those things are not insurable. Gambling, for example, the stock market, you can't insure if you lose money in the stock market. That's speculative.
Exactly. So basically, when it comes to insurance, things that are considered speculative risks, like gambling or the stock market, aren't covered because there is a chance of both winning and losing. Insurance is really meant.
Okay, let's go to the next one.
I'm glad that made sense. If you have any more questions,
All right.
or if there's any.
It's better if you have them on the phone, bro, because right now,
All right, let's do it.
it's
Just let me know what the next question.
see, it's not even listening to me. So if you have it on the phone, it's probably better so that you could um have it on the phone while you're talking and listening to this, and it's gonna help you. Like I said, it's like having a tutor that's helping you. Profitable distribution of exposure serves for the purpose of what? Preventing the insurer from being stopped. B, protecting the insurer against adverse selection. C, helping an insurer determine payable benefits. Or D, helping the insurer select only the ideally insurable risk. And so profitable distribution of exposure is it serves as a purpose of protecting insurer against adverse selection. So this is all Chinese, bro. Like if I'm like in your shoes, this is like profitable distributions of exposure, adverse selection. You don't use those words in real life, you know? So this is just something probably in a way, memorize it, you know? Because this is a unique question that's the way you're gonna see it always. So so just make the connection. When you hear profitable distribution of exposures connected with adverse selection, profitable distribution of exposures, adverse selection. That's just something you're gonna have to memorize because I don't even know how to um, explain what is profitable distribution of exposure. So, but I'll try, okay, to see if it makes sense.
Yeah.
So insurance is to help people when they have a claim, right? But also it's not a nonprofit organization. It's for profit. So insurance companies, how can you be profitable? How? By distributing the exposure to the loss to many, many people. That's called. So if you distribute the exposure of loss to many, many people, now insurance becomes profitable. Because let's say on life insurance, if you're my only client and you pay $100 a month, but if you die, I pay your family, let's say 500,000, then who's taking the bigger risk? Me, the insurance company, because your loss is only $100 a month. I'm 500,000. So if you die, I'm screwed big time. I'm probably going out of business. If you live, I'll make a little profit. Not a lot, but I'll make a little profit if you live long time. And that's what that is, a profitable distribution of exposures.
starting to see the picture.
See that? So I'm exposing it to just one versus exposing it to millions of people. Now it becomes profitable distribution of exposures. Okay. Okay. So probability distribution of exposures exists when poor risk are balanced with preferred risk. So poor risk are people that are, no, these are people that are sick. They're unhealthy. They have diabetes, cholesterol, high blood pressure, DUIs. They are, they have a crazy lifestyle, high risk lifestyle. Okay. So that's poor risk. Okay. Preferred risks are the opposite of that. Preferred risks are people that are super healthy, they drive careful, they have no speeding tickets, they don't drink and drive, they don't have no diabetes, cholesterol, high blood pressure, right? They're not too fat, they're not too skinny. So that's preferred risk. So so an insurance company needs to balance those two out. They can't like if there's 1,000 poor risks, they have to have 1,000 preferred risks so that it balances it out. Again, it's profitable because it's distributed evenly. You see that? The purpose,
Based on the risk, like the higher the risk, right, which is poor risk, right?
yeah,
When the risk is high.
yeah.
So when the risk is high, doesn't that also mean that their monthly charge or their premium would go just be a little bit more higher?
Yes, it is. Yeah, and that's going to be on the test too. Preferred risk, the rates are cheaper. Poor risk, the rates are more expensive. Yeah, that's right.
Those are more-
Exactly. It's like auto insurance, people that have no speeding tickets versus people that have DUIs and speeding tickets. Well, some insurance companies will insure you still, but man, the premiums are going to be crazy expensive. Or you're really young, you know what I mean? Yeah, same thing. The purpose behind distributing risk in this manner is to protect insurers against adverse selection. So what is adverse selection? Adverse selection is 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 people that are poor risk have a higher chance of getting insurance because they know that they need it, right?
Yeah.
So like if let's say you're healthy, you're super healthy, and somebody offers you life insurance, you're probably gonna be like, nah, that's okay. I don't need it. I'm healthy. I'm probably not gonna die yet. But but all of a sudden, let's say you find out, you go to the doctor and you find out that you have something crazy. I'm not gonna say it, right? Because words are powerful. But some crazy health issue. Now, the immediately what's going through your mind is, holy crap, this is serious. I might die. I should get insurance. You see what I mean? So that's natural human nature. So that's called adverse selection. That's called adverse selection. Okay. All right. And by the way, bro, you see how I'm teaching you? Is it making sense? Is it helping you? Okay. So I have hours and hours and hours of recording of these type of videos. So I have a playlist that I'll give to you. Um, so whenever you have like spare time, I gave you like some of them already. But there's another playlist that has a ton of that, bro, and I'll give it to you. Just remind me at the end, okay? But that's something that you could use so that you could watch the replay on YouTube and you could rewind, fast forward, replay over and over. That's mother of memories, repetition, right? Which of the following is not a characteristic. And by the way, for those of you that are watching this video, you too, I could give it to you too. Just click on the link in the description of this video, fill up that form, and I'll hook you up too for free, by the way, because I don't make profits on that. This is not my business. Which of the following is not a characteristics of pure risk? A, the loss must be due to chance.
Who's pure risk again?
Okay, pure risk is insurance is risk that is insurable. Yeah. So for example,
When I think of pure risk, I think of people who are already on their dubs.
yeah,
People who are
no,
like
that's
dangerous hiking or something.
no. Just risk is somebody that risk is no, that's hazard. Well, anyway, I can't remember what risk is, but anyways, just you have to remember there's two types of risk. Okay, so here let's
Speculative.
exactly, yeah. So let's define risk. Let's see. Possibility of loss. So if there's a possibility of loss, then it's called a risk. Okay. So the possibility of loss, harm, or undesirable outcome resulting from particular action. Okay. All right. So there's two types of risk, pure risk and speculative risk. Pure, just all you got to know about this is keep it simple. Okay. Pure risk is insurable. Insurance companies will give you a policy if it's pure risk. But speculative risk, they won't. Let's say you come up to me and I'm an insurance company and you say, "Hey, I'm about to gamble all my money. I'm about to enter a tournament and I'm gonna go all in. And I want to insure it just in case I lose." That's a speculative risk. And the insurance company is gonna be like, "Pff, whatever. What do you think we're crazy or what?" They won't insure that. Make sense?
And then pure risk is someone who just rather not gamble, right?
Oh man, I wasn't sharing the screen all this time. So pure risk is pure risk is like insuring my car, life insurance, insuring my health, insuring something that there's no chance of gain. Okay. Speculative risk, you have a chance of winning or losing. So if there is a chance of winning or losing, then it's speculative. Pure risk, there's only a chance of losing or staying the same. There's no chance of winning. So for example, if I drive, can I make money if I drive? What's the risk of driving? That I might get in a car accident. It's a loss. But if I don't get in a car accident, I don't make no money. I just stay where I'm at. You see what I mean? That's pure risk. Okay. So life insurance, I could live or I could die. If I live, I don't make no money. But if I die, it's going to cover the loss. So there's only a chance of losing or staying the same. That's called pure risk. And pure risk is insurable. Got it? All right. So, but this one is different. This one goes deeper on pure risk. It's talking about characteristics of pure risk. Characteristics of pure risk. Okay. Characteristics of pure risk. Loss must be due to chance. Loss must be catastrophic. It's gonna be B because the loss must not be catastrophic. Yeah. Yeah. So that's actually a characteristic. You see that? But not catastrophic.
But it says on top, doesn't it say
Which the following is not. Not.
That's what I'm saying.
Yeah. By the way, that's good that you say that. On the test, they're going to try to trick you like that. On the test, you got to really read the question twice because you got to know what is it that they're asking you. Because if you don't read it twice, then you're going to think you would have thought what you thought and you would have answered the wrong answer because you didn't see the word not. See that? That's a good one, bro. That's a good one. So here are the characteristics of pure risk. The loss must be due to chance. It must be definite. It must be measurable and predictable, but not catastrophic.
So what is that trying to say though? Because like, how do you predict the loss?
Predictable, well, the law of large numbers. You could predict the loss like from a pool of let's say, Mexicans, right? We like the carnitas, we like the oily food, right? So that causes health problems. So based on the Mexican diet, out of 1 million Mexicans, how many of them have diabetes? Let's say the percentage is, or high cholesterol, high blood pressure. Let's say the percentage is 8% of Mexicans have high cholesterol because of their diet. So is that predictable then? If you look at a large number of pool of people of 1 million Mexicans and 8% are cholesterol, that means that you could pretty much make a prediction that 8% of Mexicans are high cholesterol. See that? So that's how it's predictable. So it's predictable that if you drive drunk, you're probably going to get a accident more likely than if you don't. So it's more predictable, the loss, if you drive drunk. You see that? So that's how it's predictable. Not catastrophic means that it was due to chance, basically, it's saying. So So the loss was not catastrophic because you can't predict catastrophic events. It's just here comes a hurricane, destruction. See that? But honestly, it helps for it to make sense. But in the test world, you don't want to get that deep because there's a lot of stuff that you still need to learn. Okay. You just need to know this. Okay. You need to know, like, maybe you could even create an acronym due to C, D, M, P, and C. See that? Due to chance, must be definite, measurable, predictable, not catastrophic. Because on the test, this is how the test is going to ask you a question. Which of the following is not characters of pure risk? Simple. If you know the acronym or you know that is chance, definite, measurable, predictable, and not catastrophic, then whichever is not there, then boom, that's the answer. Okay, next one. The legal definition of a person would not include what? Would not include which of the following? A family, a corporation, a business, or an individual? Yep, it's A.
That one kind of just, I kind of just
Common
knew
sense?
what it was because I know Ray really broke it down. Makes sense.
Okay, okay.
And I think there's a different definition for it being just an individual.
Individual human,
Yeah.
but a corporation. No, a business entity is not a human.
Well, I know that. No, I'm saying like there's a different definition for that.
Oh, I see what you mean. Yeah, yeah, yeah. A person versus an individual. I see what you mean. Yeah. Yep, yep. You're right. Okay, cool. All right, we don't have to go over this one, right? You can screenshot it if you're watching this on the replay. What do individuals use to transfer risk? What do individuals use to transfer risk?
Sure. So.
Yeah, exactly. You buy insurance. Insurance is you transferring risk. So if I die, I want to make sure that my family's protected. So that's a risk, and I want to transfer that to the insurance company so that I'm covered through the insurance company. It's a mechanism. You protect against a loss, so you transfer the risk against a loss. Next one. The insurer may suspect that a moral hazard exists if the policyholder is prone to depression. So this is a moral hazard, okay? You got, and by the way, you right here they just want to trick you with moral or morale.
I think there is a distinguishable difference. One of them is not carrying, and the other one is lying.
There you go. Yeah, you got this, bro. Not caring or lying. So which one is not caring and which one's not lying? That's the hard part.
Because I get mixed up all the time. So.
Morale is not caring. Moral is lying. Okay, so let's see if I'm right. I don't remember. All right, let's see. Yeah, there it is. See, moral hazard refers to applicants that lie.
Yeah, that's all you had to tell me.
So just morale is like your mood. You see what I mean?
Yeah.
And your mood, you don't care. So just remember that morale's with the E at the end. Morale, my morale's down, so I don't care. You see what I mean? But moral is I have moral problems because I lie, I cheat, I steal. I have moral problems. You see what I mean?
Yeah.
So that's a good way to remember. All right. For the purpose of insurance, risk is defined as the what?
Can't be certain that there's going to be a loss.
Oh, see that we ChatGPT defined it like this. It says risk is a possibility of loss. So the uncertainty or chance of loss. See that? So risk is the uncertainty or chance of loss. But ChatGPT explained like this. Risk is a possibility of loss, harm, or undesirable outcome. Right? So it's a chance or a certainty of loss. There it is. Just definition. Okay, right here. Let's go. Let's study here. An event that increases a chance of loss. What is that? but what's the vocab word for it? In the test, they want you to know that one too. That's on the test. It's called, ready? It's called hazard. Hazard. So an event that increases the chances of loss is called a hazard. The uncertainty of loss is called risk. The cause of loss, the cause of loss is peril. So this one is peril. This one is hazard. This one is risk. That's, I don't know. The certainty now, that's they're just trying to trick you with D, I mean. Certainty of loss, the uncertainty of loss, they're just trying to mess with you right there. Risk, hazard, peril. Got it? It would be pretty cool if I do the iPad thing. Okay. Okay, read that one and let's see if hazard. Hey, hazard. We just went over this right now.
Hazard is best defined as. Wow.
We just went over this, so you should be able to get this one right.
Pretty sure it's D.
Hmm?
D.
D?
D.
Yes. Good job. Good job. Let's see. D. Bam. Good job. There it is. See that? You're getting it, bro. It's just a little bit of study, a little bit of effort, and all right, I'm gonna log into my iPad because it always helps to be able to notate the
Recording in progress.
see if this works. Okay. All right. Let's keep going. Let's do it again. And that's what you do, bro. You just do it over and over and over until you're getting 90%. Because initially you're not going to be getting 90%. You're going to be getting 30, 40%. But you got to keep studying until you're getting 90%. Make sense?
Yeah.
Just that's really how you really study, bro, is just over and repetition. Repeat, 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 and rinse, repeat and rinse, repeat and rinse, and just keep doing it until you're getting a 100%, just like we did right now. No, not 100%. 90% is fine. Okay. But if that's without ChatGPT or Google, okay? If you're using ChatGPT and Google, then that one just to learn. You're gonna get a high percentage because come on, they're helping you, but you want to get 90% without any help. And that's when you know you're really kicking butt. Got it? Okay, let's see. This works. Nice. Very cool, man. Let's see. Nice. Great. All right, so let's go to, oh, it went to chapter 2. I don't know why. Let's go to home. Again, in California, you got to master chapter 4, 5, 1, 3, and 7. Okay. All right, here we go. An event or condition that increases the chance of loss. Okay, an event or condition that increases the chance of loss.
And the condition that increases the chance of an shared loss.
Yeah, we went over this right now. These are definitions. So it's either risk, peril, or hazard. What do you think it is? What you think, bro?
I think it's risk.
Hmm?
Risk.
No. Risk is the uncertainty of loss. Risk is the uncertainty of loss.
No, it's increasing the chance of.
Yep. So what is that?
Hazard.
Yeah, that's right. Hazard. There you go. Conditions such as lifestyle and existing health or activities such as scuba diving are hazards and may increase the chance of loss. You're getting it, huh? So what is peril?
There is unexpected.
Hmm?
Something unexpected.
Peril is the cause of loss. Okay. Risk. What is it? What's the word you're looking for? Uncertainty. Uncertainty of loss. See that? Of loss. Cause of loss. And then hazard is something that increases the chance of loss. Got it? Yeah, there's 9 questions on the test on this chapter alone. So these are the type of questions these are the vocab things that you need to know so that when you take the test, you pass it, okay? When someone purchases insurance, what risk management technique are they exercising?
So
Yeah,
transfer.
there you go. There you go, bro. Bam. If you keep doing this, you're gonna nail this test, bro. You're gonna pass it. An individual's tendency to be dishonest, moral or moral. There you go. See, now you're on a roll. Because once you got it, you got it. They could throw it at you in 100 different ways. You're gonna get it right. The growing tendency of individuals to file lawsuit and to claim tremendous amount of alleged damage is known as what? Is- no. What? Okay. Well, let's learn. Okay. What is indemnity again?
Then have it, and then they
Make it whole or restore. Mhm.
well, it's
What is it? Which one?
just like it's completely repair it.
Mhm. Yeah, that
Just
too.
give you a brand new.
Give you a brand new and just restore, repair, um, make whole. They're all the same thing. But this is not talking about that. This is a growing tendency of individual to file lawsuits or claims, or individuals to file lawsuits or claims tremendous amount of alleged damages. They're always filing lawsuits. They're always doing claims. They're just notorious.
Legal hazard.
It's a legal hazard. Yes, good job, dude. You're making the connection. Because if somebody's making a lot of claims, then that's increasing the chance of loss. And increasing the chance of loss is a hazard. And and then we're talking about lawsuits, so it's legal hazard. Perfect, bro. Good job. When must insurable interest exist in the life insurance policy? At the time of delivery, at the time of loss, when there's a change of beneficiaries, or the time of the application? What do you think?
And what's interest again? Insurable interest?
Okay, good that we haven't gone over that. Insurable interest is is there an interest to insure somebody? So for example,
Like
like like my car. Do I have an insurable interest on insuring my car? Yes, because it's my car. If a car gets wrecked, I'm at a loss. So I have an interest. I have an insurable interest on my car. Your car. Do I have an insurable interest on your car? No, because if your car gets wrecked, do I lose anything? No. So therefore, there's no insurable interest. Another example. Um, this office. Do I have an insurable interest on this office? Yeah, because if somebody breaks in or it gets burned up, I'm at a loss, right? But my neighbor's business, is there an insurable interest on my neighbor's business? No. So why is that important? Now you get it, right? But why is that important? Insurance companies will not allow you to have insurance if there's no insurable interest, right? They're gonna say, so let's say I go up to an insurance company, I say, I want to insure my neighbor's business. They're gonna be like, why? There's no insurable interest. It's not your business. Denied.
So insurable interest is like what is it? I know that in the worldly term interest means adding money that you have to pay up.
Yeah.
But this is a whole different meaning and interest and this.
Oh, definitely yes.
Yeah, 'cause I got
Yeah.
every time I took the test, I would got confused.
Oh, got it. That's good. Good point. Good point. Okay. So
You have this, so we can share it, right?
yeah, interest is not like money interest or a percentage. No, it's not a percentage.
That's what I get to.
Not in this concept. Insurable interest concept is not like a percentage interest. No. Insurable interest is, am I interested in insuring this person? Do I have an interest or interested type of thing?
Yeah.
Okay. Okay. So so if there's no insurable interest, then they won't issue a policy. Okay, because they're going to be like, why do you want to buy insurance on somebody else? There's no insurable interest. Okay. Okay. So insurable interest must exist. I'm just gonna go give you the answer here at the time of application. You're just gonna have to remember that. Okay. Yeah. So let's say, um, okay, I'm gonna just say it. Okay, it's a little explanation, but it makes sense. So me and my wife, okay, we're married. Do I have an insurable interest on her? And yes, right? Because she's my wife. If she dies, am I gonna suffer financially? Well, yeah, I am because she does things that if she wasn't around, I would have to pay somebody to do it. Like right now she's in Mexico. She's been in Mexico for a week and she usually cooks for me. Well, she's not here, so guess what I'm doing? I'm not cooking for me, so I'm buying food. I've been buying food, so there's a financial loss right there. Because if she was here, she would be cooking for me. Does that make sense? So I'm gonna insure her because if she dies, that financial loss is gonna be there. So when I filled up the application, there was an insurable interest because we were married, right? But then 5 years later, we divorce. Okay. Is there an insurable interest at that point anymore?
That would mean that you would have to.
But is there
sign the paper.
rescind the policy? No, I could still keep it active. But there is no more insurable interest. But it doesn't matter anymore because the policy was already issued 5 years ago. Does that make sense? Yeah. So I'll explain it like this. Okay, watch. So again, so the answer is there's gotta be an insurable interest at the time of application. And me and my wife,
So you're doing the application, you have. Sure.
yeah, there's gotta be an interest why I want to insure something. In this case, my wife. Okay. Okay.
Done.
So at the time of application, there was an insurable interest because we were married. But then we got divorced and now there's no insurable interest, but it doesn't matter anymore because the policy is already active. Because there was an insurable interest at the time of application, but not anymore because we're divorced. But I could still keep the policy active because because the insurable interest has to be there at the time of application. At the time of application. Does that make sense? Okay. So let's say we get divorced and then I cancel my policy. And then a year later, I go back to the insurance company and I tell them, hey, I want to get a policy on my ex-wife. Is there an insurable interest at the time of that application? There is no insurable interest because we're no longer married. We're divorced. See what I mean? Because the insurance company is going to be like, wait a minute. Why do you want to insure your ex-wife? She's not your wife anymore. Does that make sense?
Yeah.
Canceled, rejected, declined. Okay. That's good, bro. This is good detail right here too to learn. So I'm glad we're going over this. All right, we're gonna do like six more and then we're done, okay, bro? But because you already got a lot of reasons, a lot of ways, a lot of tools to help you study. Not that you were studying wrong, but just in addition to what you were studying, so that you really pass this test, okay? Following a career change, an insured is no longer required to perform any physical activity. So he has implemented a growth program where he walks and jogs for 45 minutes each morning. The insured has also eliminated most fatty foods from his diet, which Which method of dealing with risk does this scenario describe? You could use common sense on this.
Thinking right now is either reduction or avoidance.
Reduction is the answer.
Reduction.
Reduction, yeah. So it's reduction. Good job. Okay, but why is it not avoidance? Why was the answer not avoidance? Think
Because
of
there's one thing he's doing intentionally, and there's another thing that he's not doing intentionally.
like what?
Like he's going for jogs,
Uh-huh.
5 minutes
He's
in the
what?
morning,
He's going for jogs.
but then he's eliminating most fatty foods.
Most. Most is a key word, not all. You see what I mean? So if it would have said all, then it would be avoiding, right? But most means reduction. He's not eliminating all the fatty foods, just most fatty foods. So he's reducing his fatty food intake. He's reducing, reduction, reduction. You see that? So if you use common sense on a question like this, you're gonna get it right. If he would have said, um, you know, he no longer required to perform any physical activities and insured, okay, following career change and insured is no longer required to perform many physical activities. So he implements a program where he walks and jogs 45 minutes. So if you walk and jog, can you eliminate the risk? No, but you could you're going to reduce the risk. That's why it's reduction, right? Um, and he eliminates most of his fatty food, so he's still reducing the risk. Avoiding is something like this.
He would completely just left out fatty.
Completely. Or I don't want to get in a car accident, so I'm just gonna straight up not drive at all. You're avoiding the risk, right? But reduction is I don't want to get in a car accident, so I'm gonna drive really slow. Retention. Retention, retention, retention. No, that's not part of risk. Um, Here, let's read down here. The insurance changes the lifestyle of habits would likely reduce the chances of health problems. Um, no, I don't know what to tell you on that, bro. I got no comment on that. Yeah, I don't because I can't remember if it's a type of risk retention.
No,
That's a good one. Yeah, I don't know. I can't. I don't have enough information. Yeah, it's okay. When the time comes, we'll learn it if it comes. Peril is most easily defined as what? Remember peril? So hazard, risk, peril.
something that
No, that's a hazard. Something that increases the chance of loss is a hazard. So the cause of loss is peril. Okay. So this is peril right here. The cause. Remember the word cause. Okay. Something that increases the chance of loss is a hazard. Okay. And the chance of loss occurring, the chance of loss, that's risk. An unhealthy attitude about safety. No, this is just bogus. Just delete that. That's not on the test. All right, number 8. The risk management technique, it's a risk management technique. What was the other one you said that I had no comment on? Retention. It's bogus. Just delete it off your brain. Doesn't even exist. That's not on the test. Retention. Risk management technique that is used to prevent specific loss by not exposing yourself to it. What is it, bro? Not
avoidance.
exposing oneself. Avoidance. That's right. See that? You could use common sense right there. ¿Verdad? Now, again, we went over reduction, right? So you just reduce activities that increase the chance of loss. Sharing is one of them. Sharing is like a co-payment, right? Co-insurance. You share. And then transfer risk is what? You just buy insurance, an insurance contract. You transfer risk by buying insurance. Got it? Risk avoidance, eliminating the okay, you got it. I wish I would give more explanation on the other ones. If an applicant for a life insurance policy and person to be insured by the policy are two different people, the underwriter will be concerned about what? We went over this. Hmm.
Which individual will pay the premium?
Mm-mm. B. Remember, me and my wife, two individuals. Me and that business, two individuals. At the time of application, the insurance companies is gonna want to know, is there an insurable interest here? Why are you getting insurance on that other individual? Is there an insurable interest? And then you justify it. Yeah, she's my wife. Okay, then get it. Yeah, he's my neighbor. No. No, but my neighbor is my business partner. Oh, yes, insurable interest. See that? So an insurable interest must exist at the time of application policy issued. Some relationships are automatically presumed, like husband, wife, to qualify for insurable interest, spouse, parent, children, certain business relationships like business partners. Okay, what is this? Number 10. Not all losses are insurable, and there are certain requirements that must be met before a risk is proper subject of insurance for insurance. These requirements include all of the following except. That's a good one. No, that is true. The loss must not be catastrophic is a characteristic. It's looking for except. See that? Except. So B is actually, so for sure is not B. See that? Because the loss must not be catastrophic. It must be definite, not catastrophic.
Definite means it's literally gonna happen.
Yeah, like specific. It could happen. There was a reason that it happened. Oh, look at this one. The loss may be intentional. Is that a characteristic? No, they're missing something right here. The loss may not be intentional. So the answer is D. Oh, crap. I guess we'll never know. No, it'll tell us at the end. A set of legal or regulatory conditions that affect an insurance ability to collect premiums commensurate with the level of risk incurred with would be considered a what? A legal peril, a underwriting gamble, fiduciary risk, or legal hazard. A lot of blah, blah, blah in this question.
Would be considered A, and that's where I get lost.
I think it's
It
D.
sounds like a whole lot of gibberish.
Oh my God. Did it again.
Submit answer.
I get it. It's hiding. It's hiding. It's like, I'm gonna make it smaller here. There we go. Submit. Okay. Which of the following statements is not true concerning insurable interest as it applies to life insurance? Not true.
I'm just trying to process the entire sentence.
Yeah.
Which of the following statement is not true concerning insurable interest? You did mention something about insurable interest earlier. You said it was not a fund. It wasn't kind of money.
No, not a
It
fund.
was if they're interested in fund,
Yes.
in insuring it.
Yeah.
That applies to life insurance.
Yeah, you're getting it. You're getting it. So watch. This is what's happening actually right now. You ready? This is good. This is good for recording. Right now, we've been studying for a while and your brain is starting to hurt. In fact, you're getting tired because now you're reading those sentences. You're like, what the heck did I just read? So that means you're a little fatigued. And this is normal. So this is why also you want to take a bunch of practice exams because so that your brain gets conditioned on taking the real exam so that you don't get tired like on question number 25, 30, or 40. Because you got to take 75 in California, for example. So that's why you want to take a bunch of practice exams so you condition your brain for that mile run or for that marathon. Because if you're just used to doing a mile, but the marathon's 24 miles, you're screwed, right? You're going to be tired by mile 12. So your brain is not conditioned to run a marathon. It's just conditioned for a little questions. So take a lot of that's another tip for you. Okay. So which of the following statements is not true concerning your insurance as it applies to life insurance? A debtor has an insurable interest in the life of the lender. Okay. This is a whole different topic right here that we haven't even touched on. Pero um, debtor is the person that owes money, has an insurable interest in the life of the lender, which is a person that lend you the money. And the answer here is that one, because it's actually the other way around. The lender has an insurable interest to the person that owes him money, the debtor. See that? Not the other way around. So this is on credit life. Okay, so this is a whole different topic. This one's on types of policies. You're going to learn about credit life.
I think it's the basic one goes down. I think that's what it was.
The face amount goes down, which is decreasing term. Yes, you're right. You're right.
Nice. Or
The debts get paid off. Yes.
pays off the amount that's owed.
The amount that's owed. Exactly. Exactly. Yeah. Yeah. So, so credit life. Yeah, you did it. You did it. That's good.
Comes together, it's just I need to keep,
Yeah, keep studying because
areas.
because you're already getting it. You're understanding it. You just need to now connect it with insurable interest. So credit life, insurable interest. What does insurable interest have to do with credit life? Well, credit life, there's two people, two different people. There's a creditor, which is a person that lend the money, and the debtor, the person that borrowed the money. So if the bank lends somebody money, the bank wants to get paid back even if he dies. So the bank is going to force this guy, this borrower, to buy a credit life policy in case he dies. The bank gets his money back, right? So is there an insurable interest? Yes. The creditor, the bank, has an insurable interest on the life of the debtor because if he dies, the bank is screwed. But right here, look at A, what it's saying. A is saying the debtor has an insurable interest to the lender. See that? It flipped it. That's what makes it wrong. See that? That's what makes it not true. That's why it's the answer. Got it? So that means that B, C, and D are true. Let's review them just so we could learn. Business partners have an insurable interest in each other. Yes, business partners. A married person, yeah, my wife. An individual has an insurable interest in his own life. Yes, I'm insuring myself. That's an insurable interest. See that? So you could have even gotten an A right by just process of elimination B, C, and D. Got it? Very cool. We got them all right. Yeah. So the ones that we skipped over, we got them right. But so here I recorded this, so you could always go back and it's a good idea when you're watching these videos, pause the video when the question. So like for example, let's say I'm gonna go back to a chapter quiz again. Okay, I'm gonna go home.
Gonna say just go to another page and then go back and check.
Just go here. All right, so I'm gonna do a quiz. So here, as you're watching this video, what you want to do is pause it here and then read it, answer it best that you can, and then play it and then watch my interaction and teaching so that you could learn. Okay. That way you're killing two birds with one stone. And then if you have ChatGPT, you're killing three birds with one stone. And then you'll learn, bro. Okay. All right, let's stop it here.